Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
The lower middle market is often described as, well, a kind of chaotic gold rush. You have these savvy investors and acquisition entrepreneurs, ETAs, competing like crazy. They're often looking at dozens and dozens of targets just to find that one gem.
Oh, the pressure is immense. I mean, you have limited time, a limited budget for your due diligence. It really means you have to get good and fast at sorting the promising businesses from the total time wasters. You need an objective filter.
And that is exactly our focus today. We're talking about the art of early-stage risk assessment in acquisitions. We're taking a deep dive into the specific framework the pros use to spot those deal killers long before they're spending six figures on legal fees.
Right. We're looking for the things that doom a deal from day one. And our roadmap for this comes from a really valuable guide. It's called A Practical Guide to ETA Deal Pre-Screening. We're looking at the November 2025 edition, and it's authored by the private equity and ETA consultant Iman Khan.
So the whole mission here is really about clarity and speed. This framework, it's designed to be a pre-diligence filter. It lets you as a buyer move faster, stay objective, and really focus your attention on the opportunities that actually fit.
Exactly. It's a way to maximize your efficiency before you commit any real money or time to formal due diligence. And that structured approach is just so vital because it takes the emotion out of it. Khan's process is broken down into 3 logical tiers. They mirror the actual stages of an early evaluation, which gives you an immediate sense of how severe a risk is.
Okay, so let's unpack that structure. Where do we start? The absolute non-starters.
We start with Tier 1. These are the immediate deal killers. Think of these as level 5 walkaway factors. We're talking about issues that should instantly disqualify a business from consideration.
Instantly.
Yes. The source is very clear on this. These are problems that 99% of the time, no amount of creative deal structuring or post-acquisition work is going to fix. They just fundamentally break the thesis.
So Tier 1 is that big, red, non-negotiable stop sign. If you see it, you're out. So what's the difference between that and, say, Tier 2?
Tier 2 is for what the guide calls likely deal killers. These are serious red flags. They sit at levels 3 and 4 on a severity scale. So they aren't automatic disqualifiers like Tier 1, but they materially increase the risk. And they require deeper analysis, and this is the key part, very strong mitigation if you're going to proceed.
And even if you can mitigate them, I'm guessing it makes the deal less attractive?
Oh, for sure. The presence of a Tier 2 issue, it almost always reduces the overall attractiveness and ultimately the valuation of the business.
Okay, so Tier 1 is no. Tier 2 is maybe, if we can structure this thing just right, but it's going to be a headache. What about Tier 3?
Tier 3 is for your due diligence flags. Now, these factors don't necessarily threaten the deal itself, but they absolutely demand clarification, normalization, especially on the financial side, or just, more digging before you even think about a letter of intent and LOI. These are your level 1 and 2 items. They're points you need to verify, not deal breakers.
I really like that the guide is specific about when to use this system. It's not a checklist you run after you've got a full data room, is it?
No, absolutely not. The speed is the entire point. You apply this framework immediately after that first owner call, or, as soon as you get those preliminary materials.
The teaser, the CIM.
Exactly. The teaser, the confidential information memorandum, the CIM, or even just basic financials and tax returns. The whole purpose is to be efficient by killing the broken deals fast.
Wait, so hang on. You're saying we're not even waiting for the data room. This filter starts with literally the first phone call, the first gut check.
Precisely. You maximize your time by running that very first conversation through this filter. You're trying to spot a level 5 risk that might be buried in a casual comment about, say, their biggest customer or their reliance on one piece of software.
That's a real shift in mindset.
Okay.
Okay, let's go deeper into the rating system Khan's guide uses, because standardizing risk seems essential here. I mean, when emotions are high, having an objective 1 to 5 scale is what stops you from falling in love with a bad deal.
Completely agree. And that's what the severity level 1 to 5 does. It provides structure and comparability across different kinds of risks. As we said, level 5 is the ultimate deal breaker. That's synonymous with tier 1. Then you drop down to the high end of tier 2. Level 4 is a severe risk, rarely salvageable. This is often an operational or market issue that frankly requires a complete transformation of the business to fix. Level 3 is a moderate risk, but it needs strong mitigation. This is the lower, more manageable end of tier 2. You can survive it, but it's going to take serious work and cost, and that's usually structured right into the deal terms. And finally, you've got levels 2 and 1. Those are the tier 3 due diligence flags. Level 2 is a low to moderate risk, usually fixable pre-close, and level 1 is just a minor observation. This whole scale gives you a common language to discuss risk with your team, your advisors.
And what's so fascinating is how comprehensive this is. The guide doesn't just look at the financials, it forces you to look at 4 key dimensions of risk.
Exactly. Every risk you find has to fall into one of these 4 categories. It ensures you get a sort of 360-degree view of the business right from the start.
Okay, so those 4 dimensions are, first, structural and operational. It's all about the core mechanics, the systems, how the business actually functions day to day.
Second is regulatory and legal. That's focused squarely on compliance, any existing lawsuits, and liabilities that could, crater the whole thing later.
Third, financial and market. This covers the economics, scalability, and all those external factors like the competition or industry stability.
And last, the one that's often overlooked but is so critical, owner-related. This is all about issues specific to the seller, their behavior, how central they are to the business, or just, can you trust them?
Right. So when you combine the 3 tiers, the 5 levels, and these 4 dimensions, you've got this strategic grid for assessing a business from the very first contact. Okay, let's zero in on the biggest time saver, the immediate killers, tier 1. The guide says if you find a level 5 issue in any of those 4 areas, you walk. So what are some common structural killers in the lower middle market?
Right. So when we're talking about structural and operational tier 1 issues, we're really hunting for those fundamental unfixable flaws, things that guarantee the business isn't sustainable. The classic level 5 risk here is crippling customer concentration.
Give me a concrete number on that. What makes it a tier 1 killer?
If a business relies on a single customer for, say, 60% or more of its revenue, and that relationship is easily severable, meaning there's no long-term proprietary contract, that's a level 5. I mean, if that one customer sneezes, the business is dead. You can't fix that overnight, and no bank is going to finance that deal.
That's a crystal clear vulnerability. What about an unfixable operational issue?
Think about obsolete technology that's absolutely essential to how they deliver their service. Let's say you're looking at a profitable logistics company, but their entire routing system runs on some custom 30-year-old software that only the seller's nephew knows how to maintain. You haven't bought a business. You've bought a ticking time bomb.
That makes perfect sense. You can't acquire a dinosaur that you can't integrate without a complete paralyzing rebuild.
And then you have the regulatory and legal tier 1 issues. These are often the cleanest, most black and white level 5 risks. If the business can't maintain a necessary license, let's say its main operating license is under formal review and will likely be revoked, or if it's facing a massive, unavoidable lawsuit that threatens solvency, that's an instant deal kill.
You can't negotiate your way out of that.
No. Not a core legal liability that guarantees the business will be shut down.
Okay, and then we get to the human element, the owner-related tier 1 issues. These can feel personal, but they are absolutely transactional deal killers.
Oh, they're critical. Even with great business fundamentals, owner-related factors can be level 5 killers. The guide points to things like a consistent pattern of non-cooperation. If they're fighting you on providing basic preliminary financials, that's a huge red flag.
What's the biggest one, though?
The most critical level 5 owner risk is undisclosed material information. If you find out the owner didn't tell you about, say, a major pending environmental violation, or that they're about to lose their primary lease, that just speaks to a complete breakdown of the trust you need for the whole transaction.
Right. If the trust is broken at that early stage, diligence is going to be a nightmare, and post-close integration is basically impossible. Applying this filter early saves you months chasing a seller you can't trust.
And that efficiency is the ultimate value here, especially for investors who are, sifting through hundreds of these deals a year.
Okay, so let's move on to the nuance of Tier 2 and Tier 3. This feels like where a buyer's own strategy and expertise really come into play.
That's right. Tier 2 risks, those are levels 3 and 4. They are survivable, but like we said, only with strong mitigation. The key difference from Tier 1 is that the business can operate and can be fixed, but that fix is expensive, it's difficult, or it requires a very specific skill set the buyer has to have.
So an example, if a business has a level 4 technical debt problem, say their whole cloud operation is non-compliant with security protocols, that's a severe risk. But if the buyer is a deep IT firm, maybe they see that differently.
Exactly. Your capabilities can determine whether a level 4 risk stays a level 4 or if it becomes a Tier 1 for your specific situation. If you don't have that IT firm's skill set, that technical debt is a level 5 for you because you simply can't execute the fix.
And what does strong mitigation actually look like for, say, a level 3 risk?
Strong mitigation means specific deal structuring. We're talking about things like holdbacks or escrows, where a chunk of the purchase price is held back until that risk is solved. Or maybe performance-based earnouts, where the seller only gets the full price if the business hits certain targets. Targets designed to prove the risk is stable. For instance, if a major contract is expiring, the earnout might be tied to successfully renewing it.
This is where the deal starts to get really complex. Heavy legal docs, reliance on projections, it just naturally makes it less attractive than a clean deal.
And that's the reality of the lower middle market. You rarely find a perfectly clean business. You're often buying a collection of Tier 2 and Tier 3 risks that you have to manage carefully.
Which brings us to Tier 3 flags, levels 1 and 2. They serve a totally different purpose, right? They're not deal threats, they're investigation points.
Exactly. They require clarification or verification. So if you see questionable add-backs in the financials, the classic example being an owner running too many personal expenses through the business, that's a Tier 3 flag. You need to verify that those costs, the owner's car, their country club membership, whatever, are truly discretionary.
So that process of financial normalization, of proving which expenses can be added back to show the true profitability, that's a Tier 3 activity. You need proof later.
Precisely. And that proof has to come from later sources, like detailed management meetings, bank statements, third-party reports. You have to ensure those things are fixed or properly normalized before you close. A Tier 3 item is the start of diligence on that specific thing, not the end.
And I'm guessing you don't just check these boxes and forget about them once you move to an LOI.
Absolutely not. The guide is emphatic about this. Buyers have to revisit their Tier 2 and Tier 3 notes constantly as the deal progresses. You have to confirm, were those initial risks actually mitigated, or did they get worse over time? If that level 3 normalization issue turns out to be outright fraud, well, that Tier 2 risk just rocketed up to a level 5.
This whole system, it just provides the rigor you need to navigate what's often a really chaotic process. It moves you past relying on a gut feeling and into a structured, verifiable assessment of risk.
The ultimate value of using a guide like ETA and Cons is that it forces objectivity. It operationalizes that early screening process. It just efficiently pushes out the severe, unfixable risks and isolates the manageable flags that just need more focused work later on.
It's all about maximizing your focus where it really counts and minimizing waste on deals that were never viable to begin with.
And applying that from the very first phone call. That's the key.
So we've walked through the 3 tiers: immediate killers, likely killers, and due diligence flags, and the severity scale that goes with them, all applied across 4 dimensions of a business. Now for our final thought for you to chew on. Given how many issues you can identify from just those early calls and basic financials, what do you think is the single most common type of hidden level 4 risk? A severe risk that's rarely salvageable, that only seems to surface once you've committed, and that formal, expensive third-party diligence finally begins.
Yeah, think about the blind spots of pre-screening. What are the expensive material problems that sellers are best positioned to hide until they have your full commitment?
Something to ponder as you vet your next opportunity. Thank you for taking this deep dive with us into a practical guide to ETA deal pre-screening by Iman Khan. We'll catch you next time.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.